More than $6 trillion vanished in 60 minutes. Gold collapsed from 5,600 to 5,100. Silver crashed from 121 to 108. In 1 hour, a historic amount of wealth was erased, and most people still have no idea why. Somewhere right now, millions of investors are staring at their screens, watching their portfolios bleed, watching liquidations trigger more liquidations, stop losses getting hunted, leveraged positions getting wiped out in a cascade of red. And as always, mainstream financial media will tell you this is just volatility, normal market behavior, nothing to worry about. That is not true. What happened today is not random, it is not mysterious, and if you do not understand why this crash happened, you will get destroyed by the next one. Because here is the uncomfortable truth. This exact pattern has already happened before. Not years ago, not even months ago. It happened in December 2025 during the last 2 days of the year. Same type of crash, same panic, same forced liquidations, same fear everywhere. And what happened right after? January exploded. Gold rallied more than 30%. Silver rallied more than 60%. One of the biggest monthly rallies in decades. So the real question is not whether today was painful. The real question is whether today was the end or the beginning of something much bigger. By the end of this investigation, you will understand exactly what caused this crash. You will understand the hidden force that controls gold and silver that most investors completely ignore, and you will understand the historical pattern that may tell us what comes next. But most people will miss the most important part because there's a specific forecast tied to a specific date hidden inside this story. And if you do not understand the mechanism, you will miss the opportunity. Today is January 29th, 2026. Around 10:30 a.m. Eastern Time, gold was trading near $5,600 per ounce and silver near 121. 60 minutes later, gold was near 5,100 and silver near 108. That is $500 erased from gold and $13 erased from silver in 1 hour. If you had $100,000 in silver at the top, you lost $11,000 in less time than it takes to watch a television episode. And if you were leveraged, if you were trading on margin, if you were holding short-dated options, your position did not just lose money, it probably disappeared. This is what people mean when they say liquidations trigger liquidations. A fast drop forces leveraged traders to sell. That selling pushes price lower, which triggers more margin calls, more forced selling, more panic, until the market reaches a point where only strong hands remain. And the people who bought at the very top, the ones who saw gold at 5,600 and silver at 121 and thought it could only go higher, they became exit liquidity for someone else. Now here is what almost nobody wants to admit. Crashes like this are not accidents. They never are. Somewhere, someone saw this coming. The large institutions, the funds, the players with access to information and positioning data that retail investors will never see, they were already preparing. They saw the signals. They positioned themselves before the move. And when the crash happened, they were not panicking. They were buying. This is how the game works. It has always worked this way. The only question is whether you want to remain the one who reacts or become the one who understands. But before we go any further, one thing must be perfectly clear. Gold and silver did not crash because something is wrong with gold or silver. They crashed because of something else entirely. And that something has a name, the dollar, the DXY. If you do not understand the dollar, you will never understand gold or silver. That is the first rule. The hidden force behind today's crash has a name that most retail investors have never even heard before. The DXY, the US dollar index. The DXY measures the strength of the US dollar against a basket of major currencies like the euro, the yen, the pound, the Swiss franc, the Canadian dollar, and others. When the DXY goes up, it means the dollar is getting stronger compared to the rest of the world. When it goes down, it means the dollar is getting weaker. Now, here's the part that changes everything. Gold and silver move in the opposite direction of the dollar. They are inversely correlated. This is not a coincidence. This is how the system works. Gold and silver are priced in dollars. When the dollar becomes stronger, it takes fewer dollars to buy the same ounce of gold or silver, so the price in dollars falls. When the dollar becomes weaker, it takes more dollars to buy the same ounce, so the price rises. Think of it like a seesaw. The dollar sits on one side. Gold and silver sit on the other. When the dollar side goes up, metals go down. When the dollar side goes down, metals go up. They cannot both rise at the same time. This is why professional traders do not just watch gold charts or silver charts. They watch the dollar first. They watch the DXY. Because the DXY often tells you what gold and silver are about to do before they do it. And today, the DXY surged. The dollar pumped hard against other currencies. The seesaw moved, and gold and silver were crushed. This is not manipulation. This is not conspiracy. This is basic market mechanics that most retail investors completely ignore. They stare at gold charts all day and never look at the dollar. Then they are shocked when this happens. The institutions do not make that mistake. Hedge funds and large traders watch the DXY constantly. When they see the dollar breaking out, they sell metals before retail even understands what is happening. By the time you see the big red candle on your gold chart, they are already out. You become the exit liquidity. That is exactly what happened today. Now the next question is obvious. Why did the dollar surge today? The answer is not one thing. It is three forces hitting the market at the same time. The first is the Federal Reserve. The Fed is sending hawkish signals. That means they are not in a hurry to cut rates and may even keep them higher for longer. Higher interest rates make the dollar more attractive to global investors because they earn better yields on U.S. assets. So foreign money flows into dollars. More demand for dollars means a stronger dollar. A stronger dollar means lower metal prices. This is mechanical. The market expected aggressive rate cuts this year. They did not get them. The Fed is still worried about inflation, and the market is adjusting. The second force is China. This one hits silver especially hard. China's industrial data is weakening. Manufacturing is slowing. And silver is not just a precious metal. More than half of its demand comes from industry. Solar panels, electronics, electric vehicles, semiconductors all use silver. When China slows, traders fear that industrial demand for silver will weaken, so they sell. This is why silver often moves more violently than gold. The third force is political risk. The U.S. government is approaching a shutdown deadline. Markets hate uncertainty. After a massive rally, many traders were already sitting on huge profits and looking for an excuse to take them. Political chaos provided that excuse. All three forces together, a hawkish Fed, slowing China, and political uncertainty, pushed the dollar higher at the same time. And when the dollar surged, gold and silver collapsed. That is the chain reaction. Now there is one more thing you must understand before we move on. Gold and silver do not move with the same intensity. Silver is gold with leverage. When gold moves 5%, silver often moves 10 or more. When gold falls 8%, silver can fall 15. This is why silver made 65% this month, while gold made 30. And this is why silver also crashed harder today. Gold fell around 9%. Silver fell more than 10. This is not random. This is how the market works. Now here's the critical observation. A few days ago, we had a silver-specific crash where silver fell much more than gold. That was about industrial demand. Today, both gold and silver crashed together. That tells you the cause is not silver, it is macro. It is the dollar, and that tells you what to watch next. If you want to anticipate the next move in metals, you must watch the DXY, not just the metal charts. Now, this is where it gets interesting because today's crash does not exist in isolation. We have seen this exact structure before, very recently. In late December 2025, during the final 2 trading days of the year, the market did the same thing. A sudden, violent sell-off appeared out of nowhere. Panic spread. Liquidations cascaded. Sentiment collapsed. Social media was full of fear and declarations that the bull market was over. Gold and silver were declared finished. The rally was supposedly dead. And then January happened. Gold surged more than 30% in a single month. Silver surged more than 60%. One of the strongest monthly rallies in decades. Everyone who sold in fear at the bottom watched the market explode without them. Now look at the calendar. Today is January 29th, 2026, 2 days before the end of the month. And we just saw another violent, sudden crash, the same emotional pattern, the same liquidation cascade, the same fear. The question is obvious. Does February repeat January? Does this crash become another launchpad? To answer that, we need to look at what actually changed and what did not. The crash today was driven by the dollar, by the Fed, by short-term fear and forced selling, but the fundamentals did not change. While the market was crashing, central banks did not stop buying gold. China, Russia, India, and others did not suddenly reverse their strategy. They buy weakness. They always have. While retail was panicking, the long-term de-dollarization trend did not stop. Countries are still reducing their dependence on the dollar. That did not reverse in 1 hour. While price was collapsing, the structural silver supply deficit did not disappear. Mines did not suddenly produce more metal. 5 years of deficit do not vanish because of one red candle. The only thing that really changed today was sentiment. And sentiment can flip very fast. Now look at market behavior in bull cycles. Sharp crashes are normal. They are how weak hands are removed. They reset overbought conditions. They create fear. And then strong hands step in and accumulate. This has already happened several times during this bull run. The real question is whether we are still in a bull market. Look at the evidence. Even after today's crash, gold is still massively up on the year. Silver is still up huge. Central bank buying has not slowed. The long-term trend of the dollar is still down. Today was a spike, not a regime change. Nothing in the data says the bull market is over. Everything says this is a correction inside a larger uptrend. But we must be honest, there are multiple possible paths from here. Scenario 1, the bull continues. This crash becomes another December-style shakeout. February starts strong, new highs by March. Silver moves toward 150. Gold moves toward 6,000. This is the most likely scenario, roughly 60% probability. Scenario 2, more pain. The Fed stays hawkish, the dollar keeps rising, China data keeps deteriorating, and we get another leg down. Gold tests the 4,800 area, silver tests around 90. This is possible, maybe 30% probability. Scenario 3, frustration. The market goes sideways, no new highs, no big crash, just choppy, exhausting price action for weeks that makes most traders give up before the next move. This is the least likely, maybe 10%. Now comes the important part, the specific prediction. Silver will be back above 120 by February 15th. Not by spring, not by summer. By February 15th. That is about 2.5 weeks from now. The reason is simple. This crash erased $13 from silver in 1 hour, but the prior rally gained far more than that. The December pattern says we bounce. The fundamentals say we bounce. The technicals are deeply oversold. And by mid-February, the political uncertainty around the shutdown will be resolved one way or another. Fear will fade and buyers will return. That is the bet. That is the call. On the record. Screenshot it. Now, regardless of which scenario plays out, the most important thing is not the prediction. It is how you respond. Now we talk about decisions. Because knowing why something happened does not protect you. Only having a plan does. Days like this are designed to expose who is prepared and who is not. They transfer wealth from the emotional to the disciplined, from the impatient to the patient. If you hold physical gold or silver, the rule is simple. Do nothing. Physical metal is not a trade, it is insurance. You do not sell insurance because the market had a bad day. You still own the same ounces today that you owned yesterday. A number on a screen changing does not change that. If you are trading with leverage, today should be a warning. Leverage in volatile markets is not a strategy, it is a liability. Gaps happen, stops get skipped, accounts get wiped. This is how liquidation cascades work. If you are using leverage on metals, reduce it or eliminate it. If you're sitting in cash, this is how smart money thinks. The best opportunities appear when fear is everywhere and everyone is panicking. That does not mean go all in. It means build positions slowly in layers, using only capital you can afford to hold through more volatility. If you bought at the top, you have two choices. Panic and lock in the loss, or accept bad timing and wait for the cycle to correct it. Bad timing is not the same as a bad long-term thesis. Every bull market has corrections. In 2020, gold crashed 30% before making new highs. In 2008, silver crashed 50% before tripling. Corrections are normal. The only question is whether you're emotionally equipped to survive them. What you should watch next is simple. First, the DXY. If the dollar keeps rising, metals stay under pressure. If the dollar rolls over, metals will rebound hard. Second, the first days of February, especially after the shutdown deadline. Third, China data. Any sign of stimulus or recovery will be bullish for silver. Fourth, the tone of Fed speakers. Hawkish means dollar strength, dovish means metal strength. These 4 signals will tell you what comes next. There are 3 types of people in markets: those who panic, those who freeze, and those who learn. Crashes are not the end of the game, they are how the game resets. Today, more than $6 trillion changed hands in 1 hour. Some people lost that money, other people gained it. The only difference between them was preparation. Markets exist to transfer wealth from those who react to those who plan. December crashed and January exploded. January crashed and February is coming. The pattern is there. The only real question is whether you will be ready the next time the market tests you.